Bianca Barlow from InvestorStream. In part one of our two-part series on investing in the electric vehicle market, I discussed the size of the market in Australia and how the removal of several key barriers to EV adoption, combined with the ongoing shift towards net zero practices, is anticipated to lead to a period of significant growth in the sector. Today I will discuss how investors may benefit from this opportunity. The economic transition scenario projecting the size of the EV market opportunity between today and 2050 as reaching $53 trillion. Aside from the environmental benefits, there are also financial benefits to be gained. The opportunities exist at several levels, ranging from direct investment in EV manufacturing companies through to indirect investment in related sectors such as battery metals and EV supply chain components. These can include companies that provide parts to EVs, such as semiconductors, or who operate in the infrastructure development of charging stations. The price surge that has been witnessed since 2021 in key EV production metals such as lithium, copper, nickel, cobalt and graphite are clear evidence of the transition that is underway. Although many investors have already benefited from these gains, the negative sentiment and bearish outlook in the current market may provide further opportunities. Coupled with industry consensus that supply of these raw materials will not be able to keep pace with demand, there are potentially further price surges in store once the market regains ground. With the EV market predicted to grow at a compound annual growth rate of approximately 22.5% between 2022 and 2030, exposure to this thematic is certainly drawing increasing interest. The recent announcement by global automotive giant Volvo provides evidence of the investment and shift that is already occurring in the sector. In a strategic move to capitalise on the growth of the Australian EV market, Volvo announced that it would move to become an electric car-only producer by 2026. This is 4 years earlier than their international target of 2030. As with any investment, there are also potential risks to consider. The uncertainty of demand has historically been seen as the highest risk in this sector. Other risks include infrastructure and supply constraints hampering the projected growth of the market. For investors that are taking a growth outlook, some risks can be mitigated by careful asset class selection. Investing in larger, more established companies will often de-risk an investment. For example, shares in mid or large cap battery metal miners are a less risky proposition than a junior explorer with unproven resource deposits. Another avenue is investing in established, market-leading automotive companies who are committed to expanding EV production as part of their overall business plan. This diversifies the risk of investing in a company that is primarily or solely EV focused, as any uplift in the EV market will still likely flow into these businesses. Alternatively, risk could be reduced through investment in exchange-traded funds that provide exposure to companies that are tied to electric vehicle or EV parts production. With numerous benefits to offer, the global transition to electric vehicles is well underway. In Australia, with a new government leading the charge, the market is projected to begin a growth cycle that provides a range of opportunities for investors who are supportive of this thematic. The size and depth of the industry ensures there are alternatives that can provide exposure with varying levels of risk to the forecast boom. And for those investors who are seeking involvement in the market, there are many avenues to explore.